Welcome, ladies and gentlemen, to a new edition of our interview presentation series. And today we want to talk with the very successful Gold Royalty Corp, and David Garofalo, the CEO, is here with us. Good morning, David, to Canada. How are you?
Good day to you. I'm
Perfect.
glad to be here.
Yeah, glad to have you here. And I mean, we have had the chance several times already to talk about your fantastic company. So today we decided to do an interview presentation because I think this is great for our viewers and makes maybe life a little bit easier for all of us. And I will jump in, of course, with some questions. Gold and silver were not easy the last weeks and not really friendly to us, but your company did extremely well, I must say. So I would suggest the floor is yours. Please get us an insight into your fantastic company.
Well, Jochen, maybe what I'll do is provide some context because we're at an interesting point in the cycle, and we've seen robust gold prices. They've been somewhat range-bound of late, but I'm very optimistic that with the continued quantitative easing that's going on, lower interest rates for longer, the significant amounts of debt that's been strapped on across the industrialized world, that we're likely to have quantitative easing and inflationary pressures for the foreseeable future. So that's great for the gold price. But the question you have to ask yourself as an investor is, how do I play the gold price most effectively to have leverage to what's likely to be a surging gold price in the coming months and years, given that quantitative easing background? And it's interesting, as I said, an interesting point in the cycle because the industry is underinvested in exploration and development over the last half a dozen years. As a result, we've seen a significant decline in reserves, off about 40% since the peak of the cycle, 6-7 years ago. And that means that if you want leverage to the gold price, you're not likely to get it in the operating companies. They just don't have the reserve basis. They don't have production growth. And as a result, they're all going to have to rush out and reinvest back in exploration and development in a meaningful way. But in order to do that, they need capital. And royalty companies have always played a meaningful role in the ecosystem to stimulate exploration and development. We've provided access to capital when capital isn't available from traditional means for the explorers and developers. And I would say selectively, explorers and developers can raise capital right now on their own, but most of them are going to require a conduit like a royalty company in order to do that. And in that type of cycle, when you see cost inflation start to rear its ugly head, we've seen inflation in the general economy, but because of that underinvestment and need to catch up in the mining sector, we're going to see significant input cost inflation. So I think the best place to be in order to participate in the gold upside while insulating you from input cost inflation is in the royalty space, because we take a percentage of the top line and we have full leverage to the gold price. We have full leverage to the exploration success of the operators that we partner with, but we insulate our shareholders from operating and capital cost inflation, which I think is going to rear its head going forward. But in order to provide an effective source of capital, you have to have a low cost of capital, you have to have scale. And embedded in our DNA is the roll-up strategy. In other words, M&A, in order to achieve that scale very quickly. We IPO'd only in March, and we raised $90 million US from that foundational asset base that was spun out of Gold Mining Inc. back in March. And then we immediately did a transaction with Ely to double our size. And then recently, after completing the Ely merger in August, we announced a three-way merger with Golden Valley and Abitibi to double our size again. So we've gone from $200 million to $400 million market cap, and now upwards of $800 million on a pro forma basis as a result of the completion of that transaction. That helps us achieve scale quickly and puts us in a position to lower our cost of capital and be an effective capital provider for the explorers and developers in the sector. And so where we've gone in the last 6 months is from effectively 0 royalties to almost 200 royalties on a pro forma basis. So we've achieved that scale both on a market cap basis and also in terms of the size and diversity of our underlying royalty portfolio. And we now have, with the acquisition of Abitibi and Golden Valley, a cornerstone asset in Canadian Malartic. We have a royalty on Canada's largest gold mine. And much as Goldstrike built Franco-Nevada, this is our Goldstrike. Canadian Malartic is a Goldstrike quality asset with a very long life, with quality operators in Agnico Eagle and Yamana. and with 30 to 40 years of reserve life ahead of it, with significant exploration upside at depth as they start to build underground infrastructure to start mining there. So this is clearly a foundational asset for us. Jochen, you had a question?
David, how did it come that you really have on a portion of Canadian Malartic the royalty? Because I always had the feeling this is Osisko Gold Royalties only.
Well, there's multiple royalties on that asset.
Okay.
As I'll show you in a few minutes. We actually have a 3% NSR on a significant portion of the underground extension that Agnico and Yamana are currently constructing. They're investing $1.6 billion currently in the construction of an underground mine, transitioning from open pit to underground. And so the royalty portfolio on Canadian Malartic is a patchwork. Osisko has some of it, we have some of it, but this will be a meaningful source of cash flow growth for us going forward as they exploit more and more of that underground resource.
How many ounces do you expect then from the royalty in the future per year?
Well, you know, they're delineating the underground resource. They're sinking a shaft into it. We think approximately half of the production coming from underground at Canadian Malartic will be subject to our royalty, but it's a little early to determine because as they get underground and put that underground infrastructure in place for production, they also open up the underground horizons for exploration. And the tradition in this camp is when you do open things up from underground, they tend to the deposits tend to bloom geologically, they tend to balloon. And that certainly was the case with the LaRonde mine, which I was on the team that constructed that back in the 1990s and early part of this century. Once we got underground and got that underground infrastructure, the deposit grew dramatically. And as we see that kind of potential with Canadian Malartic, and we think a significant portion of it will be subject to our 3% NSR as they delineate that resource from underground. But what you'll see, a recurring theme in our portfolio is a significant concentration of our royalty portfolio beyond just Canadian Malartic into Quebec and Nevada, the two best jurisdictions in the world in which to operate, as judged by the Fraser Institute for mineral potential, low political risk, and low regulatory risk. And we have a significant portion of our portfolios there. We exit this transaction with a very strong balance sheet, almost $50 million in cash and no debt. And I'll talk about the management team a little later on, but collectively we have 300 years of operating and mine development experience in our board management, which is a distinguishing feature of a company and a key competitive advantage relative to our smaller peers in the royalty space. The re-rate potential we see is immense here. As we collect these assets and amalgamate them together, we see significant potential for a much higher multiple. As I said, scale matters. It drives up your multiple, drives down your cost of capital, and really creates a bit of a virtuous cycle to continue to grow the business and grow the value of the business for our shareholders. Very briefly on the transaction that we've announced just in late August with Golden Valley and Abitibi. I won't go through all these details. What I will say is we have a high degree of confidence in closing the transaction because 65% of Golden Valley shareholders have signed support agreements, and 65% of Abitibi's shareholders have signed support agreements, and 38% of Golden Valley's shareholders. Golden Valley owns 45% of Abitibi, and that's why we're doing this three-way merger, is to clean up that holding company structure, which will give an immediate significant premium to their shareholders, but also the potential for a re-rate within this much larger portfolio within Gold Royalty. This is the asset base in a very summary fashion. As I said, focused in the Americas, 191 royalties, 6 in production currently, so we have significant cash flow currently, 7 in construction. So the upward trajectory in our cash flows over the next 3 to 5 years as these construction projects come into production is immense, and I'll talk about that a little later on. But across the value creation spectrum in the mining sector, we have royalties from early stage exploration through to feasibility of almost 180 royalties. And so that's a lot of organic growth embedded within the story post the merger with Golden Valley and Abitibi. Much of that actually came with the merger of Ely that we closed back in August. So we created scale quickly, we created a strong balance sheet, and we have a strong management team that's executed very, very quickly in the 6 months that we've been in existence.
I've just a question because I saw Colombia. How do you feel on that new proposed tax regime? I think it was like yesterday or 2 days ago. They brought into a new tax regime, and I think they raised the corporate tax by 4%, for example. And I think also there are some royalties to the state then in the future. Are you affected on this on anyhow, or how? What's the
certainly
outcome?
not directly as a royalty owner on these properties, but to me, I'm optimistic about seeing that kind of stability within Colombia, because while it's an investment grade country, there's been a lack of clarity on the regulatory environment for new mining ventures, and having some clarity around the tax regime allows us to make, and allows the underlying operators to make rational investment decisions. So I'm optimistic about what that means for Colombia. I think that'll actually stimulate additional investment in new mining infrastructure because of the stability that brings, that clarity around the regulatory regime and the tax regime. So switching back to Canada, and I want to talk briefly about Canadian Malartic. As you can see, this has been an open pit mine and Canada's largest gold mine for about 10 years, operated by Agnico Eagle in Yamana. So there's significant surface infrastructure here, an 80,000 ton per day plant. As they go underground, they're actually going to be ramping down production, but higher grade material down to 20,000 tons per day. But that means there's a lot of headroom in the surface plant, and there's a lot of exploration potential along the property position, which could fill that plant in due course. So there's lots of optionality embedded in that infrastructure they've built up over the 10 years they've been in operation. The underground infrastructure will allow us to help drive our revenue upwards. This is what our revenue profile looks like on a pro forma basis. We already have meaningful revenue within the portfolio post the merger of Ely, but really what this portfolio does is really ramp that up to almost a 5-fold increase in revenue. And that's without the benefit of the underground potential at Canadian Malartic, which is still to be delineated, and I think will provide a meaningful source of revenue growth for many, many years to come. And it's difficult to define until they get that underground infrastructure in place and start to drill it out. And this gives you a sense of the patchwork of the royalties that are on the property. These represent our royalties. And if you look at the middle center of this aerial map, that's where Odyssey is being built, the underground deposit. That's where our 3% NSR is. And we feel quite optimistic as they delineate that resource from the underground infrastructure that an increasing proportion of the production will be subject to our royalty and drive revenue growth for the foreseeable future. So that's quite exciting for us and a source of organic growth post the merger. And you can see the underground potential here. The grades are substantially higher than what we've been mining from surface drilling. And as I said, LaRonde, the mine that defines Agnico Eagle and is only 30, 40 kilometers away from this deposit, started out as a localized small zinc deposit from surface drilling. But then we made the decision to sink a shaft, initially down to 1,000 meters, then down to 2,200 meters as the deposit ballooned at depth. And now they're mining down to 3,000 meters at LaRonde, again, just 30, 40 kilometers away from here. And really what drove that production at depth was the underground infrastructure and the underground drill setups to drill those lower mining horizons, which drove the growth in the deposit geologically. And we see that kind of potential here as they go underground for the first time at Canadian Malartic to get those underground drill setups from the production platforms.
So that looks to me like, I think there was an 18-year mine life so far, but that looks to me like that this could be extended much, much longer. Is there a cap on the royalty, meaning time-wise or ounce-wise?
Not at all. And that's the beauty of anything in our royalty portfolio. We have no capped royalties. We have the full exploration optionality that you should demand as a shareholder from royalty companies. If they're buying capped royalties, what's the point? Because then you might as well buy the ETF, you might as well buy physical gold. What this is like owning physical gold with exploration upside. That's the way a royalty company should be structured to provide that full exploration optionality. And that's the case for every single one of our 191 royalties in our portfolio. Outside of Canadian Malartic, you'll see I'll be bouncing back from Quebec to Nevada, Nevada to Quebec. Ren represents, I talked about Canadian Malartic being our gold strike. Well, we actually have exploration exposure to gold strike. We have the Ren underground extension where we have a royalty, and Barrick and Newmont under the Nevada Gold Mining joint venture have announced they intend to incorporate rent into their 10-year mine plan, which would allow us to grow meaningfully our cash flow from Nevada over the next 3 to 5 years as they integrate that into their operations going forward. So that's a source of growth in Nevada. Back to Quebec, we also have the Fenelon project in Quebec, operated by Wallbridge. Wallbridge invested tens of millions of dollars in an exploration program, 300,000 meters of drilling over the last 3 years. This year, they ramped that up to 170,000 meters of drilling and 10,000 meters of underground development in a $70+ million program, which will culminate in an inaugural resource in the next month or so. And so we see that as also a meaningful source of cash flow growth over the next 3 to 5 years as they rapidly put this into development. And beyond that massive portfolio, we have another area that we can generate royalty opportunities. When we announced the acquisition of Ely, we not only acquired their assets, we acquired their team, their founders, Trey Wasser and Jerry Bowman. Trey and Jerry founded the company 10 years ago by generating their own royalties. Jerry's a prolific prospector in Nevada, and what he does is he stakes claims and then farms out the properties, doesn't spend any money on exploration, gets the juniors and the senior producers to invest in the exploration, and we take royalties back. So by staking these claims, farming them out, and taking royalties back, we have a source of significant royalty portfolio growth. And in fact, Jerry's generated over 100 royalties doing that over the last 10 years. And it costs us next to nothing. So lots of optionality embedded in that. Similarly, in acquiring Golden Valley and Abitibi, we're asking Glenn Mullen to join the team. He'll be joining our board as well. Glenn is the founder of both companies, Golden Valley and Abitibi. And like Jerry, he's been focused in Quebec, doing exactly the same thing, generating royalties, staking exploration claims, farming out the properties, and taking royalties back. And so we're very fortunate to have him on the team. And most recently, we made a small $2 million investment in a private company called Prospector Royalty Corp, led by Tim Young, a very, very successful prospector in his own right in Canada. And he's digitized terabytes of information on the exploration side, is using that same data to mine for royalty opportunities. And everything he finds, we have a right of first refusal on as a result of that investment in this private company. So we have 3 platforms for generative royalty opportunities that really cost us next to nothing to generate. And that's the advantage that we have in Gold Royalty. We have a lot of growth embedded organically without having to do any more M&A.
Sounds like a perpetuum mobile.
Yes. and then just talking briefly about our operating partners, we're very proud of the teams that we've associated ourselves with a very strong ESG focus. We've looked at a number of royalty opportunities where we've simply passed because of the lack of quality in a particular operator, where they may not have proper safety standards or environmental standards. That's certainly not the case for any of these operating partners. We have scores of them, and all of them operate properly, both from an environmental standpoint, from a safety standpoint, social standpoint. We're very proud to have these partners. So it's a key criteria for us, gating criteria for any royalty opportunity we look at, that these people have a strong track record on ESG practices and principles before we put any dollars to work with them. And then our overview of our portfolio from a metal standpoint, geographic standpoint. There's been a proliferation of new royalty players that have come into the space over the last couple of years. And as I said earlier on, they tend to lack focus. They tend to be too diversified on the metal side. You can see we're very, very squarely focused on precious metals, with nearly 90% of our exposure coming from that. And we're focused in the 2 best jurisdictions in the world, in Quebec and Nevada. And otherwise, our portfolio is in low political risk jurisdictions, exclusively in the Americas. And as I said earlier on, we have a pipeline of opportunities from early stage exploration through to production, which I think is the envy for anybody else in the royalty space in that sub $1 billion category. And speaking of the sub $1 billion market cap category, this is where we stand relative to our peers. On a market cap basis, actually, this is stale. Our stock has been up 20% since we announced this deal. So this was done before we did that. On a pro forma basis, our market cap actually exceeds Mavericks. And so we would become the biggest in that sub $1 billion market cap category on a pro forma basis. In terms of trading liquidity, again, this is stale. Our trading liquidity actually exceeds $5 million per day. since we closed the Ely transaction because our float has increased dramatically. Liquidity matters. Institutional investors are looking for companies they can get into and out of quickly without disrupting the share price. So if we can have a more liquid share, and then we're likely to have a much higher multiple as a result of attracting that kind of institutional interest. Number of royalties, we dwarf our competitors. And again, we started from zero a year ago. When we founded the company as a private company, we went from 0 to 200 royalties seemingly overnight, but really over the last 6 months as we successfully completed our $90 million IPO in NYSE. And as I said, on a pro forma basis, we exit with an early $50 million in cash and no debt on the balance sheet. Again, puts us squarely up near the top of our competitors in terms of our trading liquidity, our balance sheet liquidity, the number of diversity of our royalties, and our market cap. And very briefly on the management team and the board, over 300 years of collective experience. What I would say is heavily skewed towards the technical side. I come from a mine operating development background. That's certainly the case for Alistair Still, Sam Ma, Alan Hare. This is collectively a very strong team. Ian Telfer as well, our chairman of our advisory board, founded Wheaton Precious Metals 15 years ago. Now it's the second biggest royalty and streaming company in the world by market cap. So we are very much pursuing the playbook that he pursued when he founded Wheaton Precious Metals in a spin-out from Goldcorp, my old company, 15 years ago. And then this just gives you a sense of the pro forma share ownership. And then very briefly, the potential for a re-rate here. You can see where the category killers are. In Franklin, Nevada, Wheaton Precious Metals, typically 2 to 3 times their net asset value. Royal Gold is around that area. We have a lot of ground, a lot of real estate to make up with them, but scale will allow us to do that. This gives you a sense of the potential re-rate, potentially doubling or tripling of our share price from where it is currently if we achieve that sort of multiple through the scale that we've been able to achieve in very short order. And that's the exciting opportunity here. It's certainly what we sold the shareholders of Elion, of Golden Valley, of Abitibi, is that potential for a double bump. We gave them an upfront premium, but collectively, with the scale that we've achieved by putting our companies together, we see the potential for a significant re-rate for our shareholders collectively that we can enjoy together.
Fantastic. Super. That's it?
That's it. That's the presentation.
Super. Thank you very much, David. That was great. Fully understandable that, yeah, your stock is skyrocketing and that you have appreciated a lot in the share price. Question. We saw that revenue stream curve going up, up, up. Is it for you, let's say, an objective to pay in some years a constant dividend, for example?
Well, you know what? Royalty companies at the end of the day are like an annuity. And if they are an annuity managed as such, and it's a growing annuity, there's no reason their shareholders shouldn't experience that annuity as well. So as we integrate these organizations within the broader Gold Royalty, we will be revisiting returns of capital to our shareholders and starting to put a dividend on the table. That's inevitable. I think those are fundamental to a good royalty story. So watch this space over the next 6 months to a year as we start to integrate these organizations into Gold Royalty Corp.
Fantastic. So you have now 191 royalties altogether. Do you want to grow that to 250, 300? Or do you say, hey, maybe it's a little bit, we need some time to digest the whole thing?
Well, you know, there's no reason for us to stop. We'll continue to add royalties into the portfolio. For us, we're allocating capital expecting to get double-digit rates of return. And as long as that return on capital criteria are met, then we're in a position to scale up quickly. And the beauty of our model is we have half a dozen employees. We could run a business 10 times the size of what we have today with the same human footprint. It's not like we're operating the mines. We're managing the royalties. We're allocating capital. We're more a financial institution than we are a mining company, a financial institution that's exclusively focused on providing leverage to the gold price and exploration for our shareholders.
With almost, let's say, $50 million cash to round it, do you have enough firepower to step into new royalties, also big royalties? And I think you have also secured, if I'm not wrong, a revolving credit facility, right?
We do. So between that, our free cash flow, which we're actually starting to generate already, and our line of credit, we have significant financial firepower, you know, probably upwards of $75 million, including our line of credit US. So lots of capital we can put to work. But again, what really drives our decision making to buying royalties is ones that generate that double-digit rate of return for our shareholders with full exploration optionality. We don't cap our royalties, as I said earlier on. If our operating partners are successful on the exploration upside, then our shareholders benefit from that upside as well.
Could you imagine to go into, let's say, more different metals? Okay, uranium we forgot about because you have uranium royalty in your group of companies, I would call it. I spoke with Scott last week. And but could you imagine, for example, what I wanted to say is I've interviewed several royalty companies, and I see the focus is always like gold, silver, copper, I would say. Okay. Could you imagine to go, let's say, into lithium, zinc, stuff like this? Would that make sense? Or is that also, let's say, a kind of expertise you say, maybe a little bit too tough for us?
Yeah, look, I think our shareholders demand focus. And I think the companies that have diversified too broadly have seen their multiples erode. And when that happens, then you get into a vicious cycle where it becomes difficult to compete for new gold royalties. And so we're going to be squarely focused on precious metals.
Okay, super. Last question. What's your tip on the gold price year end and next year?
Look, I'm looking for $3,000 an ounce next year. And Jochen, you and I have talked about this before.
Yes.
The all-time high for gold was not last year when we were at $2,000 an ounce. It was actually back in 1981 when gold achieved $850 an ounce. And in today's dollars, that's $3,000 an ounce. So I'm not pulling that out of my hat. There's no reason, given this inflationary cycle that we're experiencing, and it's just ramping up, that we should achieve the same inflationary high we saw post the hyperinflation period in the 1970s.
Definitely. That's a great final sentence, David. Thank you very much. Always a pleasure to talk to you and to listen to you. I would say you guys have extremely well done. Congratulations to you and to the team, of course. And I would say, please keep it going because it can only go even better.
Thank you very much.
Thank you very much. Yeah, ladies and gentlemen, that was David Garofalo, the CEO of Gold Royalty. And you heard it. The company is doing extremely well. 191 royalties they have on the book so far. Then this great merger, I would call it, together with ABTB and Gold Valley. So this is really the creation of something really big here in the royalty space. They are doing extremely well. Enough firepower on the balance sheet with credit facilities. So yeah, we look forward to dividends soon. And I would suggest check out this fantastic company. Thanks for watching us and bye-bye from Switzerland.